Okay, so here's a look at the broad market today in the form of the good old familiar S&P 500, which is up, let's see, how much? I know they said the Dow was up 600 points today. I use percentages, not points. So the S&P 500 is up 2%. Let's just take a look at the Dow since I did just mention that as well. Dow is up 1.73%. Okay, so that's pretty good. What's going on? Is the economy slowing down enough to warrant the Fed decreasing interest rates? And that could make for a market rally? Well, that appears to be exactly what investors are hoping for and thinking today. Now, there was some data released this morning showing that economic activity in the services sector dropped below a reading of 50, which is consistent with a recession in the broader economy. And I want to just add this here. A lot of analysts and economists have been saying that this could be kind of a contraction in the economy, a recession, but doesn't have that familiar kind of decimation of jobs, like big job losses that we've seen in previous recessions. So that would be interesting and good news if that did occur. And a lot of people are forecasting that right now. Now, speaking of jobs, payroll numbers were released this morning and showed that jobs increased more than the economists who track this kind of thing expected, which is good. We can all appreciate that. But wage growth is slowing. Now, that seems bad on the surface, given all the inflation that we are seeing everywhere. I think everybody can agree that prices are rising. Most of us are seeing this, right? But wages and inflation are related. So it's kind of counterintuitive that slower wage growth is good for markets. It can signal that the rate of inflation may keep declining, especially because slower wage growth gives companies one less reason to hike prices as aggressively as we have all been seeing. Now, price increases help companies protect their profit margins from higher labor costs. Makes sense. Lower inflation could mean that the Federal Reserve might pause interest rate hikes sooner than expected. That's why markets are cheering today. So let's take a look at some of these indexes. Here's the NASDAQ today. We have that up 2.3%. I just showed you the S&P 500 and the Dow. I always like to look at international equities, not just U.S. They do kind of tend to move in tandem lately. In the past, they've been considered kind of asset classes with lower correlation. That hasn't been so true in terms of developed markets anyway. So this is the EFA. It is an ETF that tracks an index of developed markets outside the U.S. Hello, that's up 2.41% today. Let's pop over here, look at something called the EEM, which tracks emerging markets. And that one is up 1.86% today. So we're kind of seeing equities across the board are rallying. Now, what's the point? Why am I showing you this? Markets can turn on a dime, okay? I run into this a lot. People aren't aware of market direction and they miss rallies because they believe the market is still in a decline. And I understand this because the news media is relentlessly focused on the negative. They understand that's what audiences want to see. That drives clicks, that drives advertising dollars, it drives viewership, and the big media companies deliver on the negative. But the effect is you get everybody constantly saying the world is falling apart, it's going to hell in a handbasket, or phrases like that. And they overlook legit good news, like medical advances that literally happen all the time. For example, here's an article I just found. Rolling MRIs into hospital rooms, getting closer to solving sickle cell disease, zapping prostate cancer, treating rotator cuff injuries, stopping bleeding for new mothers after giving birth, treatment for obesity and Alzheimer's disease. There's medical devices being developed all the time that are increasing and improving treatment. I write about this a lot for MarketBeat. But you wouldn't know about all this because all we hear about is Kevin McCarthy's pathetic attempt to become Speaker of the House. But I digress. You know, it's funny because I work with my friend Serge Berger over at the Steady Trader, and he reminds me all the time that folks who are active traders tend to very often be overly optimistic about market direction. But in my years as a financial advisor and money manager, I found that longer term retirement investors tend to be overly negative. I frequently talked with people as late as 2019 who had no idea how far markets had rallied after 2008. No idea. And these were people with retirement accounts who were investors and had no idea that their accounts had grown so much in value in the last 9 or 10 years. Or people who are all in cash and wonder, why is my account not appreciating? Well, it's because you don't know what's going on in your account. You're holding cash. That's not going to do anything. So you do have to know what is going on. You don't have to track the market every day. In fact, I recommend against this because it makes you crazy and it gives you a distorted view of the market. But don't bury your head in the sand and be in denial either. If the markets are moving higher, you need to know that to better understand your retirement strategy, as well as taxes, other withdrawal strategies that you will need to implement. Okay, that's all I got today. Thanks for watching. Hope you found that helpful.